Welcome to a new episode of Inside the Economist's Mind. Today, we're plunging into the really fascinating world of exchange rates and how we measure them,
Yeah, it's a big one.
especially for a trading nation like Australia, right? These rates are, well, absolutely crucial. They influence everything from, I don't know, the price of your coffee to how competitive our exports are.
hmm
And get this, the Aussie dollar, it sort of punches above its weight. It's actually the sixth most traded currency globally.
It really does. And in this deep dive, we're going to unpack the methods economists use to understand and track the value of a currency.
Right.
Think of it as getting a clearer picture of a vital economic signpost. One that impacts your holidays, maybe your online shopping sprees, and definitely the livelihoods of businesses, big and small.
Exactly. So our mission today is to try and demystify the different ways exchange rates get measured and the various systems countries use to figure out their currency's worth.
Yeah, take something that can seem a bit abstract.
And make it accessible and, well, hopefully even pretty interesting for you. So where should we start?
Well, I think a logical starting point is probably the most common measure, the bilateral exchange rate.
Okay, bilateral, meaning two sides, right? So just one currency's value compared directly to another.
Precisely. And, it's pretty standard practice to quote these rates against the U.S. dollar,
Yeah.
given its central role in global finance.
Yeah.
Take our own currency, the Australian dollar. You'll often see the AUD-USD rate quoted.
Right. Like if AUDSD is, say, 0.75, that just means for every Australian dollar I hand over, I get 75 US cents back. It's pretty straightforward when you think about swapping holiday money or buying something online from the States.
Exactly. And it's not just us thinking about holidays or shopping. Businesses involved in international trade, they rely heavily on these bilateral rates.
Oh, definitely.
When they're buying inputs from overseas or selling their goods and services abroad, it directly hits their costs and revenues.
Makes perfect sense. Okay, now what about these cross rates I sometimes hear about? They sound a bit more involved.
They do sound maybe a touch more complex, but the idea behind them is still based on those fundamental bilateral rates. A cross rate is essentially an exchange rate between two currencies that isn't often quoted directly. So we calculated using a third currency, typically the U.S. dollar, again.
Okay, maybe give me an example to help it click.
Certainly. Let's say you want to know the rate between the euro and the Australian dollar EUROD. You might not find that quoted easily, not like EURUSD or AUDSD.
Right.
But if you know both the USD rate and the AUDSD rate, you can actually derive the EUROD rate. The calculation is basically EUROD equals EURUSD multiplied by USD AUD. See how the USD is in the denominator of the first one and the numerator of the second? They effectively cancel out, giving you the direct rate between the euro and the Aussie dollar. It reflects this idea of no arbitrage.
Ah, I see. So you're kind of using the US dollar as a bridge, an intermediary, to figure out the value between two other currencies. Clever.
It's just a practical way to work out rates between loads of currency pairs without needing direct markets for every single combination.
Right. So we've got these one-on-one comparisons, but what if you want a bigger picture, how a currency is doing overall? That's where this trade-weighted index, the TWI, comes in, isn't it?
Correct. While bilateral rates give you those specific snapshots, the TWI provides a much wider lens, really. It measures the value of a domestic currency, say the Australian dollar, against an average of a whole basket of currencies from our key trading partners.
So it's not just the US dollar, but maybe the Chinese renminbi, the Japanese yen, others we trade a lot with.
Precisely. And the importance, the weight of each of those currencies in the basket is determined by their share of our international trade. So a country we trade with more gets a bigger weight. And this could be based on total trade, or sometimes just imports, or just exports, depending on what you want the index to show.
And what does the TWI tell us that just looking at, say, AUD-USD doesn't?
Well, the TWI gives you a better sense of whether our currency is generally appreciating or depreciating relative to all our main trading relationships on average. It tends to smooth out some of the wilder swings you might see in individual bilateral rates.
How so?
Well, for instance, there might be times when the Aussie dollar weakens against the U.S. dollar.
Right.
Maybe U.S. interest rates go up, but at the same time, it strengthens against the Japanese yen because Japan's economy is doing something different.
Okay.
TWI averages those movements out. It might show a more stable overall picture of the AUD's international value, and that can be really useful for understanding our broad trade competitiveness.
So it's a more holistic view then. Our currency's international standing averaged out. And you mentioned it tends to fluctuate less because some of those individual movements can cancel each other out in the average.
Exactly. Now, we've talked about how we measure exchange rates, but the next really crucial piece is understanding the different systems or regimes, as economists call them, that countries use to determine their currency's value.
Okay, so moving from the measuring stick to the rules of the game. I know there's a kind of spectrum, right? From just letting the market decide completely to fixing the value really tightly.
That's a perfect way to put it. At one end, you have freely floating exchange rates, and at the other, fixed or pegged rates, sometimes called a hard peg. We can broadly lump them into floating and pegged regimes.
Let's start with floating then, since that's what Australia's been doing since what, 1983? Quite a while now. What's the core idea there?
In a floating regime like Australia's, the value of the currency is primarily determined by supply and demand,
Yeah.
just forces in the foreign exchange market,
Simple as that.
pretty much. If there's high demand for Aussie dollars, maybe because everyone wants our iron ore, its value tends to rise. If there's more supply than demand, perhaps because Australians are investing heavily overseas, it tends to fall.
So it's like any other market, really, driven by buyers and sellers. And you mentioned this has helped macroeconomic stability for Australia. How does that work exactly?
Well, a floating exchange rate acts as a kind of shock absorber for the economy. Let's say global demand for our exports suddenly drops.
Okay.
The value of the Aussie dollar might then depreciate, making our exports cheaper for overseas buyers. That can partially offset the initial fall in demand, cushioning the blow.
Ah, right.
And importantly, it allows our central bank, the RBA, to focus its monetary policy, things like interest rates, mainly on domestic conditions, like inflation or unemployment, rather than constantly having to manage the exchange rate to hit a specific target.
So it gives us more flexibility to respond to what's happening here at home. But are there any downsides, any challenges or risks with a floating currency?
That's a really important question. While it offers that flexibility, a floating rate can also bring volatility and uncertainty, and that can make it harder for businesses to plan, especially if they trade internationally.
I can imagine.
Big sudden swings in the rate can really impact their profitability.
Yeah, absolutely. And you mentioned most of the big global players, the US dollar, the euro, the yen, the pound, they also use floating rates.
That's correct. These are generally currencies of large developed economies. They usually have deep, liquid financial markets that can handle those fluctuations.
Okay. You also touched on this theory, purchasing power parity PPP in the long run. What's the gist of that? I vaguely remember hearing about, like, the Big Mac index. Is that related?
Exactly, that's the one.
Yeah.
The theory of purchasing power parity, or PPP, suggests that over a very, very long time, exchange rates between two currencies should adjust, so that a basket of identical goods and services would cost basically the same in both countries.
Huh.
The Big Mac Index, which The Economist publishes, is a fun and informal way to illustrate this. It just compares the price of a Big Mac across different countries. In theory, it gives a rough idea if a currency is over or undervalued compared to the US dollar.
So, in theory, a Big Mac should cost roughly the same in Sydney and New York once you adjust for the exchange rate, though I'm guessing reality is a bit messier.
You're absolutely right. In the real world, you don't often see it play out perfectly neatly in the data. There are lots of reasons: trade barriers, transport costs, local taxes, and the fact that many things, especially services, aren't easily traded internationally.
Right, the real world always gets in the way of nice theories.
Hmm.
So, okay, forgetting the super long run, what actually drives exchange rate movements in the medium term and the short term? Under floating, that is.
Good question. In the medium term, things like differences in interest rates between countries are really significant. If Australia has higher interest rates, for example, that can attract foreign investment from people seeking better returns.
Okay.
That increases demand for Australian dollars and pushes its value up. Also, the relative international competitiveness of our industries matters, and just the overall economic outlook compared to other countries. If Australia's economy looks strong and growing, that boosts confidence in the Aussie dollar.
Okay, so it's about where investors think they can get the best returns and the general economic vibe, and in the short term. You mentioned speculation and news earlier.
Yes, day to day, even hour to hour, exchange rates can jump around quite a bit due to market speculation, traders basically betting on which way currencies will move, and also just breaking news or events that change perceptions about a country's economy.
Like what?
Oh, anything from the release of new inflation numbers to big political changes, or even, sadly, natural disasters.
Wow, sounds like it can be a bit of a roller coaster in the short term. And you also mentioned a difference between freely floating and more managed floating. What's the key distinction there?
Well, in a truly freely floating regime, the central bank hardly ever intervenes in the foreign exchange market to try and influence the currency's level. They pretty much let the market decide the rate.
Hands off.
Mostly, yes. In a more managed float, however, the authorities might step in more often. They might buy or sell their own currency to try and limit excessive volatility, maybe smooth out big jumps, or nudge the rate if they feel it's way out of line with economic fundamentals.
Right, so they're trying to smooth out the roughest bumps without actually fixing the rate. Okay, let's switch gears then to the other main category. Pegged exchange rate regimes. What's the fundamental idea with these?
In a peg regime, a country's monetary authority deliberately ties its official exchange rate to another currency, usually a major one, like the US dollar or the euro, or sometimes a basket of currencies.
Okay.
The main goal is to keep the exchange rate at a specific target level, or maybe within a very narrow band around that target.
So it's all about creating stability and predictability then, by linking your currency's value to something else considered stable.
Exactly. It provides a very visible anchor. And that can help build confidence in the currency, particularly for, say, smaller economies or those with a history of high inflation or instability. It can also make trade and investment easier and cheaper with a country whose currency it's pegged to.
But how do they actually do that? How do they keep the currency pinned at that target rate when market forces might be pushing it elsewhere?
They have to actively intervene in the foreign exchange market. So if their currency is starting to fall below the peg, the central bank will step in and buy its own currency using its foreign currency reserve, like US dollars or euros.
Ah, increasing demand.
Exactly, which supports the price. And conversely, if the currency is rising above the peg, they'll sell their own currency, increasing its supply in the market and pushing the price back down towards the target. They effectively have to stand ready to buy or sell whatever amount is needed to maintain that rate.
That makes sense. They're basically using their reserves to counteract the market forces and stay on target. But you also mentioned this limits their monetary policy independence. How so?
Well, because the exchange rate is fixed, or very tightly managed,
Hmm.
the central bank loses a lot of freedom to use interest rates for domestic goals.
Right.
If they, for example, wanted to lower interest rates significantly to boost their economy, that might make holding their currency less attractive compared to the currency it's pegged to. Money could flow out.
Putting pressure on the peg.
Exactly.
Yeah.
Downward pressure, which means they'd have to intervene more, selling foreign reserves to buy their own currency. And doing that too much can rapidly deplete those crucial reserves. It relates to something called the impossible trinity or trilemma in international finance.
Impossible trinity.
Yeah, the idea that a country generally can't have all three of these things at once. A fixed exchange rate, independent monetary policy to manage its own economy, and free movement of capital across its borders. It usually has to choose two out of the three.
So they're essentially trading off that monetary policy flexibility for the stability that comes with a fixed exchange rate. And it sounds like you need a pretty big war chest of foreign currency reserves to make a peg credible and defend it if the market tests it.
That's absolutely right. Maintaining a credible peg requires substantial reserves. You need enough firepower to convince the market you can and will defend the target rate. If markets start to doubt that, it can trigger speculative attacks, potentially forcing the country to abandon the peg.
You gave the example earlier of the Danish krone being pegged to the euro. Can you tell us a bit more about that one?
Sure. The Danish krone is pegged to the euro, yes. It has a central target rate against the euro, and it's allowed to fluctuate only within a very, very narrow band around that rate.
So not absolutely rigid, but close.
Very close. The Danish central bank actively manages the krone's rate, mainly using interest rate adjustments and direct intervention in the FX market to keep it within that tight band. It really reflects Denmark's very strong economic and trade links with the Eurozone.
Interesting. So even within pegged systems, there can be slight variations, though obviously much less freedom than a floating system. Now, we have a chart here. It shows the Australian dollar against the US dollar and also the trade-weighted index over time from 1989 up to 2024. What does this visual tell us, thinking about what we've just discussed?
Yeah, looking at that chart, you can really see the fluctuations in the AUD-USD bilateral rate quite clearly. Those ups and downs reflect all those medium and short-term factors we talked about influencing a floating currency. And you'll likely notice, visually, that the AUD-USD line tends to have more pronounced swings compared to the trade-weighted index line. The TWI, as we discussed, is generally smoother because it's averaging out movements against that whole basket of
All
currencies.
right.
So the chart provides a nice historical illustration. It shows the different ways we measure the Aussie dollar's value, how they can sometimes diverge, and it highlights that broader sense of stability captured by the TWI versus the specific relationship shown by the bilateral rate.
All right, the TWI gives that less volatile, more general trend, while the bilateral rate shows those sharper, sometimes quite dramatic ups and downs against one specific currency. Well, this has been a really enlightening deep dive into measuring and managing exchange rates.
Indeed. And just to quickly recap the key takeaways.
Hmm.
We looked at the basic bilateral rate, how cross rates are derived from those, and then the bigger picture from the trade-weighted index, the TWI.
Yep.
And then we contrasted the two main systems, floating regimes, like Australia's, where market forces are generally king, and pegged regimes where the authorities actively manage the rate against a target.
And understanding these concepts is, well, it's really important, isn't it? Even if you're not an economist, anyone who travels or shops online internationally or is just curious about the forces shaping our economy, you're indirectly affected by these rates and systems all the time.
Absolutely. It's a fundamental piece of the whole global economic puzzle. So maybe here's a final thought for you to ponder. Think about Australia's long-standing choice since '83 of a floating exchange rate. How might that choice influence how our economy responds to big global events, like a sudden boom in commodity prices or a major financial crisis somewhere else?
Hmm.
Compare that in your mind to how a country with a pegged exchange rate might have to respond differently. Think about those trade-offs we discussed, the flexibility versus the stability and the potential pros and cons of each system when you're navigating this complex global economy we live in.